foremost, thank you so much, everyone, for joining today's webinar. Today's webinar's topic is the Great Rebound, how mortgage companies are changing tactics in 2025. I'm Steve Smith. I'm the CEO and co-founder of BaseCap. If you don't know who BaseCap is, we work with mortgage companies across originators, servicers, and investors. We focus on life of loan quality assurance. I'll be moderating today's discussion. I'm really thrilled to have such an insightful panel with us. We do have a Q&A function, so if questions come into your mind throughout the discussion, please feel free to tap that button and ask your question. If we have time, we'll be sure to get to it. What I'm really excited about in terms of this group here is it's the full sort of diverse backgrounds that everyone brings to the table. When I think about how a loan comes to market and the pieces of why lending exists, right? It's an element of how do borrowers get the houses they need. Lenders are in the business of making loans. So how is that optimization happen? It's almost like a scale, and we're in November, right? We're coming to Thanksgiving. We're at that moment of the new year. So how is the scale going to adjust relative to all of the inputs across the space? And I think the panel today has the expertise and the insights to share in terms of maybe a little bit as to what's coming in the new year. So with that all said, I'm going to leave it to the panelists to introduce themselves. I'll hand it over to quickly go through that. And Christy, you want to kick us off?
Absolutely. Thanks so much for having us today. This is going to be a fun discussion. As you guys can probably tell, we started a couple minutes early, and there was definitely a little bit of a comedy session going on. So it's always good when there's good interaction. So I'm Christy Soukhamneut. I'm the Chief Lending Officer at UFCU here in Austin, Texas. I have been in the mortgage business since we don't want to talk about when, but this is not my first volatile down market. In fact, I've been through many of them, including starting in the business when we typed things in triplicate on carbon paper. So it's been quite a while and quite a journey. So much has changed and so much is still the same. I feel lucky to be able to continue to do this and do this with great people like everyone here on the call. I'll hand it off to Taylor.
So my favorite was canary, but some people were more of like a goldenrod person. Christy, what was your triplicate personal preference on the document structure?
Whichever one didn't have whiteout on it.
Whichever one. So most people, like many of the people watching this webinar, don't even know what whiteout is. And you know you're in trouble when you use the whiteout and you see the whiteout on the computer screen later. My name is Taylor Stork. Like Christy, I've been through a couple of the ups and downs and sideways turns of this business because I was kind of born into it. I am a certified mortgage banker like Christy. She and I did the program together. And I work for a mortgage company and I do lots of advocacy work. And I love coming on programs like this and talking about what's happening in the market, what we think is going to happen in the market, where we think the industry is going to go. And hoping that I was right when 6 months later, I relook at the recording and realize that I was completely wrong about everything I said.
All right, Kat.
Yep. I'm Kaiyoorawongs. I'm the CEO and co-founder of LoanSense. I am not an executive to the mortgage world for many years. However, my expertise lies in how to qualify more borrowers that may be disparately impacted by high debt. So I bring that passion at the intersection of mortgage. I was declined for my first home, and I knew it was something we had to address to help Millennial and Gen Z get across the finish line. So today we work with many lenders, and I get to see some best practices that I can share, not just about our product, but some best practices. How are people leveraging technologies, and how do we think about the market as sales cycles may be a little longer with interest rates or people shopping or wanting education earlier. Happy to contribute to this discussion and honored to be part of this panel. Thanks.
Thank you so much, everyone, for being here. So just to sort of set the stage, right? The market is always dynamic, right? That's what actually keeps things interesting. They go up, there's up cycles, down cycles. Recently, we've had 2 Fed rate cuts. Fitch upgraded a number of non-bank lenders. We've got a new presidential administration. And of course, tech innovation is a constant, right? We're always innovating. We're not maybe doing things in triplicate, but there's definitely tons of data and triplication of data sets out there. So in some ways things you evolve, and in other ways they continue. So just to sort of kick us off, right, as we head into 2025, what key factors do you expect to shape the market differently than previous cycles? What's different about this year? How do you see declining interest rates impacting this shift? And I'm going to toss it over to Taylor to kick us off.
To start, fine. So it's interesting that we've been talking about declining interest rates impacting the market for like a year now, right? And there was a phrase being spun around 6-9 months ago, survive to 25. And I hate that phrase, by the way, because I think it has such a negative connotation for 2024, that all we can do is survive until 25. I think there's great opportunity for those who know how to find it and those who know how to harvest the opportunity. But having said that, this concept of interest rates going down, we have been in nearly a 20-year downward cycle in interest rates. So if you look at historical starting in 2001, right? So post 9/11, we watched the interest rates start just basically doing this over a long period of time with a couple of little minor blips up. Our industry, for the most part, we have not been in a normalized interest rate environment for 20 years. And I actually think that where we are today is closer to what a natural normal interest rate environment actually is for mortgage. If you look at 200 and 300-year graphs and charts, going back to pre-Revolutionary War, historically interest rates sit between 5 and 7% for real property. And so we are right there in that band, and we'll probably stay in that band. So there's a lot of hope that we're going to see significant cuts and 4% handles and then 3 handles and then whatever. I just don't personally think that that's realistic or likely, and there's a lot of reasons why. So when you start to look at interest rates through that framework, and you say, okay, a 6% interest rate for real property is a normalized interest rate, and you layer in several complex dynamics. Is it federally supported through the agencies, or is it private PLS structured? What are the different things that are influencing interest rates and why? I think that as originators, it becomes implicit and important to figure out how each individual loan officer and how every organization can fortify their business strategy so that they can be successful, whether it's a 6-handle rate or a 5-handle rate or a 4-handle rate. Lenders lend, and you got to be able to lend regardless of what the environment is like. And so I think that there's going to be a lot more focus on that as we come through winter of 2025, is how to ensure that you're able to profitably participate in the lending environment that is rate agnostic.
Well, Taylor, I think it's funny that you talk about it that way. I saw a post on LinkedIn. I believe I even shared it with our group, our CMB group chat, that the refi fairy is not coming. And we've lived in historical cycles where, to your point, we've been in this downward decline, but we've had bips up, and then we've had those, we've come back down, and that has always fed the beast, if you will, or the engine. And so when you've had that, refis were always this icing on the cake, and the cake was your purchase business. Well, today we're not going to get that extra scoop of icing or ice cream that's going to come in and revive the industry for a couple of reasons. When you think about it, we've seen property taxes and insurance increase dramatically, and when the number of borrowers that are at the debt to income levels that are barely getting approved because of the housing affordability issues, now you add in higher taxes and insurance, their debt to income isn't going to qualify for them to be able to refinance unless it's some kind of a streamlined refi. So the pool of eligible borrowers is going to shrink, even if they're in the money, if you will, from an interest rate standpoint. And so that looks a lot different in today's environment than it's been in any cycle that I've ever been in. In addition, we're seeing delinquencies spike on things like credit cards and auto loans. And so you may be current on your mortgage, but are you current on your other bills? And are those delinquencies going to keep you from refinancing? And I look at it as a consumer. If I'm paying my mortgage, why shouldn't you give me a lower interest rate that only puts me in a better position if you want me to keep paying it? And that's the philosophy of a VA IRRRL or an FHA streamline, right? We
Yeah.
don't have those same programs on conventional loans. And what about the number of people that, Kat, this goes right into your world, that have student loans that didn't have to pay them for several years. And now we're just starting to get reporting of whether or not they paid them over the last year when they had to go back into repayment. And
Yeah.
the data tells us that many folks aren't paying them, that
Yep.
they actually didn't think they would ever have to go back to repaying them. So they went out and took out additional debt that is the same or greater payment as what their student loans were. And so now they're in a worse position. And so as an industry, just the pool that we get to fish from is a lot smaller. So I think that's going to be a big headwind that we face that we haven't as an industry really had to face in the past.
Can I
Yeah,
just,
so I just want
go ahead, Kat.
Oh, I was just gonna second what Christy was saying with there's about 9 million people who entered repayment in the student loan world who just didn't pay. So they there's significant lags on credit reporting. So they're going to take a lot of credit hits. We're going to see a downward in credit scores, which obviously impact, and then it's their ability to buy. But then secondly, I just wanted to mention people who bought their first homes or even second homes, and now they're at an age where they want to downsize, right? And sell that first home. They have a lot. The highest growing amount of debt is one of the categories are parent plus loans, parents taking out for the education of their children. And so there's a lot of guilt. Well, I took out for my first child. How can I not for my second? How can I not for my third? So they're taking out 6 figures for their children. And so now the people it threatens retirement, but those that are going for their second home. So it's not even just impacting the first time buyer market, 40% of the first time buying market. It's now impacting the ability to refinance, but also going for the downsize, the generation that now wants to downsize, right? So it has a significant impact that is well beyond just the 20 to 30-year-old we think about. And so, yeah, there's a lot happening as things have been stop reported from the student loan world, but also debt in general, consumer debt, credit card debt, it's all going up. And so prime credit score borrowers, I learned this statistic today, prime credit score borrowers, 69%, okay, that's 2/3 of Americans, hold revolving balances on our credit cards. And that's just causing credit cards to go up as well. And so there's a lot of different things that I think the mortgage world can bring to help consumers manage this debt. All types of debt, if we do want them to be able to refinance, or we do want them to be able to buy that second home. So I'll definitely pass it to Taylor. I know he wanted to add.
No, I'm not going to let Taylor go just yet. Sorry, Taylor.
Yeah.
The average non-mortgage debt, according to LendingTree, across the 50 largest metro areas is almost $38,000. It's $37,827. And that's in auto loan debt, personal debt, student debt, credit card balances, other. So that's the average is almost $38,000 per human of eligible borrowing age. That's significant. And that is up dramatically, by the way.
I would be willing to bet that the first and second deviations of that average take you up to double the number, right? So if the average, because that average is going to include a whole lot of people who have zero. Like people who are under the age of 18, right?
No, it doesn't. Only legal borrowers, right? So only 18 and up.
Okay, so there's a whole lot of people that are going to have less than the average, no matter how you slice it, which means that there's a bunch of people that have more. And I would argue that if you look at the right-hand side of what is it, a Z-tail? For the deviation, I would be willing to bet that you're looking at a whole lot of people in the $70,000 up to $100,000 range. And if you want to talk about refinance opportunity, that's really where I think the refinance opportunity is going to be. I do not believe that Santa Claus is coming to town. I do not believe that we're going to wake up one morning with Christmas gifts called refinances sitting underneath the Christmas tree, or the Hanukkah tree, or the whatever tree, depending on which tree that you've got. What I do believe is that there is a significant overlooked opportunity for real financial support and planning and guidance for customers who need thoughtful support by professional originators, by professional loan officers to navigate these kinds of scenarios, the exact scenario Kat just described. Because let's be honest, everybody's been, hoping that the refi bell was going to ring. We've had 2 rate cuts and rates haven't gone down. They're actually going up. And it remains to be seen whether they will go down, because the secondary markets are reacting in ways that a lot of people didn't anticipate. Let's be honest. We also have a changing environment. To Kat's point, student loans have been given significant preferential treatment for the last 4 years. And with the new incoming administration, I think that's going to change. A lot of people think that's going to change and change quickly. And that's going to have a direct impact on lenders' ability to refinance, because remember how we qualify student loan payments. A lot of us use the either or rule, and the or on the rule has been preferential, and that or option I think is going to go away, or at least change. The math is going to change, the calculus is going to change, making it more difficult to qualify those borrowers. And to the point that Christy made, I personally, believe it or not, I'm a licensed loan officer. And I do a loan every once in a while, just so that I can keep my hands in the dirt and stay relevant and know what's happening. And one of my own personal clients reached out to me and said, I'm in trouble. My homeowner's insurance went up 40%. So I started surveying the marketplace, and 40% is actually a small number. People are getting larger increases. And this was not a homeowner in Florida. This was not a homeowner in fire-prone California or Texas. This was a homeowner on the interior side of New Jersey, where there are no hurricanes, where there are no fires. So I had an interesting exchange with Mark Calabria about a month and a half ago, mid-September. And we were talking at an event about, and for those of you that don't know, Mark is the former director of the FHFA under a previous administration, and he will undoubtedly serve a significant role in the new administration. One of the things he pointed out was that within the credit box over the last several years, we have been, as an industry, originating a substantially higher concentration of high DTI loans. And that concentration of high DTI loans was for a number of reasons. Post-2021 refinance space, we were struggling to get borrowers qualified. And so when you're struggling to get people qualified and rates are higher, you're originating at the upper end of that 48, 49 DTI for conventional, 55, 56 for FHA. So it's a much higher concentration of loans at that upper end of the spectrum. And so to Christy's point, when rates go from 7 down to 6, and suddenly it's like, okay, let's go refinance, I'm in the money. But you take that 55 DTI that you did last time, maybe 48 on a conventional, let's say, 48 DTI that you did last time, and you're in the money, but then you take your property insurance and increase it by 30, 40, 50%, and then you increase your property taxes another 10, 20, 30%, because we're all looking at significant property appreciation over the last 2 years. Take that little filter and place it over the fact that 70% of the existing loans were originated in 2020 and 2021. So you only have 30% of the outstanding to begin with. 30% of the outstanding mostly originated at higher DTIs. Most of them have higher insurance and property taxes today. And to Kat's point, a lot of them have student loans tacked on to their DTI calculations. I don't see a big, huge rate term refi scenario coming our direction. But what I do see is borrowers that need to reorganize their debt. Now we're talking about cash out refinances, and we're talking about seconds, structured HELOCs, and some other things that do start to make a lot of sense.
So we spoke about month and a half ago, and it's sounding, general consensus. We've got affordability pressures. To your point, there's opportunities potentially with restructuring, right? Has anything changed materially in terms of the view between a month and a half ago and today relative to, the election and changes? Are there any predictions as it relates to how the new administration is going to potentially adjust the market or influence it?
It's a huge left-hand turn pivot, Steve. I mean, how deep do you want to go on this?
We don't need to go super deep, but in terms of purchase and refinance predictions,
Sure.
What's changed in the last
Kat has to go first.
Okay, so while Taylor and Christy think about what the predictions are going to be under Trump, I can tell you one thing to just address something Taylor said. In the student loan world, Trump can take away SAVE, which got about 5-6 million Americans $0 payments. And Freddie did not accept $0 payments. They had to use 0.5. Fannie did if the bar got right documentation. That program will likely go away. It's under the Supreme Court review right now, and it will likely not come back because it made payments too low. Under Trump, though, Trump cannot take away income-driven repayment programs, specifically income-based, because it was legislated by Congress. So there are programs in place that Trump cannot take away unless Congress, which we do have a Republican Congress, they can say we want to legislate away specific federal student loan programs. The reason I think that that's politically unpopular is because we still have a very strong healthcare lobby, hospital lobby, and they very much benefit from being able to provide public service loan forgiveness to doctors who would otherwise go into private practice. So there's some power from healthcare to keep programs like that. And so I think they're going to get away. They're going to eliminate a lot of Biden's efforts to legislate bar defense. He did it with executive orders, bar defense, and various programs. Those will be taken away. But the core of income driven that loan officers started learning about 20 years ago, that base will still be there. That will allow people to have some forms of reduction in payment to be able to get their cash flow up and pay off other debts. That will still be there. So I just wanted to mention that because I know there's a lot of fear. Oh my God, it's all going to be taken away. What are people going to do? All this and all that. I know there's a lot of talk by Trump and about just getting rid of the Department of Education altogether. That to me, I don't really understand how that's going to happen because they legislate all the second largest debt outside of mortgage. They literally mandate how it should be managed. So I'm not quite sure how that's going to work, but I just wanted to mention those few updates while Taylor and Christy want to talk about their predictions on the refinance side under Trump. But
how about Christy? Same question to you. And again, the mix, the slider between purchase and refinance predictions. Anything going to change there relative to?
Look, I have a magic 8-ball somewhere, and I like to shake it up because I think that's about as accurate as anything that we say. When I was personally originating loans, which I only quit originating five years ago, I've made my living as an originator for the majority of my career. I love to do it. And I love talking to borrowers and getting through that process. But I used to say, whatever I tell you, that and $1 might get you a candy bar. Maybe if you're lucky. Today, probably only a fun size.
All right. Well,
lots of things that we can look at and talk about, but I feel pretty confident in saying that you're going to see far fewer refis, particularly as Taylor mentioned, those rate and term, which goes back to this interesting, Taylor, you brought up the survive until 25 phrase. There was a lot of this date the rate, marry the house. And you had a lot of borrowers that their loans were originated recently who expected that their house payment was going to go down, right? They budgeted for a year or two of higher payments. And then they got hit with a double whammy of interest rates didn't go down. They weren't able to do that refinance, and their taxes and insurance went up dramatically. So to Taylor's point, they're in need of some very good, savvy financial guidance on whether or not they should consolidate debts. Should they be doing a program like CAT has to help them with their IBR on their student loans? Should they be looking at refinancing or selling a car? Unfortunately, unlike 2020 and 2021, auto loan values for used cars aren't soaring. They've declined. But what does that look like to give people good, solid financial advice when you think about managing their debt structure? 97.1% of people have some sort of non-mortgage debt. What does it look like to make that better for them? And I don't think that that's going to change. I think we're still going to be fighting inflation. When you look at Trump's stated policies, which, you can think they're the greatest policies in the world. You can think they're the worst policies in the world. It doesn't matter. We're just talking about what might happen. You implement tariffs and you reduce taxes. You're looking at pressures of upward inflation. And when we have upward inflation pressures, that is going to, Jerome Powell, who clearly says he is staying on, like he's going to serve out the rest of his term, can't keep cutting interest rates if you have upward inflationary pressures. That's going to have a big impact on both purchase and refinances, but more significantly on the refinance market than the purchase market.
Can I add one thing that Christy overlooked? The enormous number of 2-1 buy downs done in the last year and 2 years for new home buyers. To Christy's point, 2-1 buy downs were huge for the last, specifically with new builds, right? But even with resales, and those 2-1 buy downs are going to come home to roost. And I promise you, even though we qualified those borrowers at the note rate versus the bought down rate, which is the rule, right? I promise you, those buyers were assuming that the rate cut promised for they were going to date for a year and then they were going to get married when the rates got better, and the rates haven't gotten better. And so you're going to see a lot of people who bought a house at 5% who are now at 6 and approaching 7, and they didn't plan for a house at 7%, nor did they plan for their taxes to double or close to double when they went from the initial assessment on new construction to the real market value of a new construction. Because that's another issue you see with new construction, is kind of underestimated property taxes out of the gate, and then they go up substantially. So you're going to see property tax jumps on new construction, and you're going to see corresponding homeowners insurance expense, increasing on new construction. All those new construction sales from 2020, 21, 22, those are going to get real expensive real fast. And all those people are going to need significant financial guidance. And that's not the kind of guidance you get from somebody wearing a headset, sitting behind a computer, off in a call center. That's the kind of a guidance that a professional, experienced, educated originator who has access to different products and different resources, who sells more than just the better rate or the better whatever. That's the kind of originator that is going to be successful in the 2025 market. And that's the originator that can pivot off of that success by earning a referral to the friends and family of that particular borrower. That's how we drive business. And that's what Christy was talking about early on when she said that refis were just frosting on the top of the cake, and the real business is the purchase business. And I believe we're going to have a very strong purchase market. I actually think with the incoming administration that we're going to continue to see housing prices increase. We're going to continue to see appreciation. We're going to continue to see a drive towards more home ownership. And I think that component of this is very, very positive. And so I'm bullish on my outlook for housing with that component.
I wanted to add, oh, I'm sorry, go on.
I was just gonna agree. Taylor's showing his brains off right now.
Yes, I wanted to say I live in Florida, so I live in a state that was impacted by all the hurricane activity, and we made claims, and I fear that my insurance is going to go up a lot, but I heard that it's also going to get distributed across policies across the US. And so my claims are unfortunately going to be costing other people across the United States a lot of money. I did want to also mention that I don't think people think about as much as an advice. Obviously, debt is always interesting. I think originators always lean with, hey, fix your credit or some credit product. It's actually from a Freddie study, credit is something to fix and most recommended, but it's actually the action that impacts your ability to subsequently qualify the least. Debt to income is number one, but then also I think something, if you're a homeowner that's interested in refinancing, I think that it's not as talked about, but there's help out there to get your property tax reassessed. I think that's also a really important tool to give people, because not that many people do it, but when you actually do it, they tend to drop your assessment just so you stop asking them in a lot of instances. So I just say that there is a process to that. Again, it involves local government. There are some tools out there that can help people do some auto assessment inquiries. So I recommend that as something as well, just to lower and help manage costs. Of course, shopping for better rates on home insurance annually is a really important item. In Florida, where unfortunately we have our hands tied behind our back because some of our homes, we only have Citizens Estate run insurance company now that will insure us. So it's harder for us, but in most other states, you can shop across multiple homeowners policies. So I always like to recommend some of those tips, even if people want to refi or not. Like, they're just tips to help manage budgets that can get, and it's a great conversation or even a great piece to send out to continue to engage, right? Those that you've helped originate, instead of just a happy birthday email or, hey, how are you doing? Happy holidays. You could say, hey, look, in our state, the property assessment time is this time. Have you thought about assessing your property as well as homeowners insurance? So I just wanted to share that as ways.
Jump into that a little bit. How, obviously smaller pool of qualified borrowers, right? That are going to be out there potentially. And we're talking about, I think Taylor, you're talking about leaning in deeper, right? Let's, how do we actually help and work with the borrower to structure things in a proper way? How do you actually go about doing that? Going a little bit deeper, like what are the mechanics behind it? What are the strategies that are being put into place to make that happen?
I mean, look, this is something that Christy and I talk about routinely, and think about from a kind of holistic approach. You got to start thinking about yourself as more than just a loan officer and behave as though you are something of a financial planner that focuses on mortgage. But I'm not suggesting that you're gonna go give advice on what stock to pick or which crypto to invest in. Please don't do that. But the overwhelming majority of our customers, our borrowers, whether they are pre-existing and past or future referrals, I mean, Kat is not wrong. There's a great deal of opportunity for people to receive some guidance and direction on topics that I would call parallel to mortgage, and homeowners insurance is a great opportunity to talk to people and say, well, your homeowners insurance just went up substantially. Have you shopped it around? And I know a guy or I know a gal, or we have an in-house solution. A lot of mortgage companies and banks and credit unions are getting smart and realizing that they should incorporate some of these products into their overall offering. A word of caution: sometimes you give a referral to a stranger because you don't have your own kind of relationship resource set up, and that stranger takes your referral and passes it to another stranger who's a loan officer at a different organization, and now you're competing by accident. So, I would caution you not to just tell somebody to go shop around. I would suggest, if you're an originator, to help them look around, to introduce them to your sphere of influence, and to use that introduction as an opportunity to reinforce within your sphere of influence that those participants should be sending their customers back to you. So, old school origination technique from back when Christy and I had to use goldenrod paper and whiteout. Wait, I never used whiteout. Just for the record, compliance team, I never ever, I don't even own whiteout. But work through your customers to find opportunities for some of your sphere of influence partners, and then ask for permission to make those introductions. And that will stimulate your sphere of interest to say, hey, you know what? You just brought me a client that had their homeowner's insurance rate go up. One of my homeowner's insurance clients that I was just talking to had their interest rate go up because some dummy put them in something called a 2-1 buy down and told them the rate was never going to change. And guess what? It did. That's where the real opportunity is. Old fashioned, sorry to say it, but old fashioned, roll your sleeves up and go out and get, shoulder to shoulder with referral sources and clients and make introductions and be a connector. The real game here is not about how many loans you have in your book of business that you can refinance tomorrow. The real game is how many referral sources can you go sit down and have a cup of coffee with and utilize, the never eat alone principles, first proposed by a guy named Keith Ferrazzi.
Let's actually expand on that, Taylor, because this is a great point. I can remember when we got in the business, beyond getting handed a phone book, if anybody remembers those, and being told to make calls, that you had multiple business sources, right? They call it, we had a 3-legged stool. That I know we called it a 3-legged stool, but it had multiple pillars of your business. And it was very common that you got a portion of your business from realtors, some from builders, some from financial planners, some from CPAs, some from insurance agents, some from divorce attorneys, or some combination thereof, depending on your market and your, the area and your expertise. So I've noticed that over time, people have really concentrated on realtors and builders as their key referral sources for obvious reasons, right? They're the ones that had the buyer leads. And as that business has shifted, we've got to remember to go back to those other referral sources. And I would call that, a consumer direct model. That's not a call center model, which I see is different. Consumer direct is where you're talking to that borrower, that member, before they're talking to a real estate agent. And there's a key opportunity here because there's a lot of confusion with the NAR settlement, with even some folks saying, is it real? Am I supposed to actually sign this, right? It may be all over our feeds and information that we have because this is what we do for a living. Every borrower out there, it is not all over their feeds. And when they get told, hey, you have to sign a buyer broker agreement before you can go look at a house, they're looking for that person to validate, is that actually true what this real estate agent is telling me? You need to be that person. But in order to be that person, you have to be there before they get to that real estate agent, because the data actually shows us that borrowers are telling us that the realtor used to control 80% of those referrals. And today that number is significantly less. While the realtor may give out the referrals, the buyer is not maybe calling that person, but may not be choosing the person that the realtor refers. They may already have a relationship through their CPA or financial planner, or maybe they went on LendingTree, who knows? But whatever it is, you're going to have to diversify your business if you want to continue to have a strong purchase business. So these things may feel like they aren't as productive as some of the other tasks you've done in the past to generate business, but in the future, I believe they're going to be more productive for you.
If I could just piggyback on that a little bit. Today is November 14th, which means, I think, right? I hope.
Don't tell me how many days it is until Christmas, or I might come through the screen and hit you.
No.
Gotta get through Thanksgiving first.
You right this minute, every single loan officer in the country, right this minute, you have 2 months before every single CPA is too busy to take your phone call. 2 months. The next 2 months of your time should be focused on making sales calls on every CPA that's ever signed a tax return, on every single loan you've ever done. If you're not doing that, you are wasting the next 2 months. Because beginning January 15th, those CPAs are going to be looking at the tax returns for all of your future borrowers or all of somebody else's future borrowers. Do you want them to be yours or do you want them to be mine? Because I'll go take them.
Kat, how about you? Any observations you're seeing in terms of adopting to the smaller qualified?
I'm So I'm seeing a lot of data and statistics, and also hearing from LOs about just expectation on lengthening sales cycles, people, shopping more, engaging earlier, and not necessarily ready to click apply now or pick up a phone, and just more educational content that can be taught, that can be presented to borrowers ahead of their desire, willingness to pick up the phone or hit apply now. Just providing educational content. There's great programs, not to sell anybody else's product, but there's great programs that can help do that you don't have to be creating all the pieces of content yourself. But I want to mention some of that as pro tips, because if you have some like guide to preparing to buy or something that can be put out that involves some really great tips on how to prepare, how to understand. There are some pretty standard questions that borrowers ask that you can go and look up on like SEO. When you Google home affordability and SEO tags of topics you can speak to, there's a lot of information like that people ask over and over that will be searched, that I think is really important. But the lengthening sales cycles and people shopping or trying to educate themselves more online before they're willing to talk to people is also a great time to start getting in front of borrowers with content. So I wanted to mention that.
That makes sense. So shifting to, all right, you have this relationship with the borrower. Recapture, right? Recapture rates have been big topics, qualification rates. What are you guys doing to address these factors? How are you thinking about those relationships that are already existing in your organizations, and how are you looking to leverage those in 2025?
I think it's a fun and interesting question, because the answer for Taylor is probably going to be different than my answer. And it's difference in business model. So we service the bulk of our loans, not 100%. I don't know that anybody that services 100%, but we service the bulk of our loans. Taylor does not service the bulk of his loans. And so we have a different model, because I have the opportunity every month for somebody to think of us when they're writing their check to me directly. And I say check, we have a number of people that still write checks. Some people do ACH, but they're engaging with us every single month when they make that payment. So if we're, I'm going to use the word lazy. If we're lazy, that's at least one reminder that we didn't have to do anything for, that they have a loan with us and maybe we should be their first call. That really is not enough. When historically in the business, when I was at servicers, we would get excited about double-digit recapture. And then we got up to, 18, 20, 25% recapture. But I remember when historically it was 7, 8, 10%. And getting to those numbers were dramatic. Today, you look at some of the really good servicers, and they're north of 70, 80, and sometimes pushing 90% recapture. So if you're not servicing your own loans, you actually have somebody you're definitely competing against today, and that's the person you sold the loan to. And so there has to be a value conversation with that borrower on a regular basis, or they're going to be thinking of somebody else. And I don't think just because I'm a servicer, that means that I'm exempt from having to provide those value conversations. I think it's even more dependent on me to provide those value conversations, because they are making that check payment to me. And I feel an obligation, because now if they're in that situation where their taxes and insurance have gone up and they now have student loans they didn't think they were going to have to repay, I have to worry that they're going to actually make their payment to us. And so I need to make sure that I'm engaged with those consumers, with our members. There's like an ownership. There are members. We highly value them. Are we providing them the right tools and resources to do that? And that helps with recapture. Recapture isn't an automatic, it's earned.
Taylor, how about you? I think Christy named you directly in that one, so you have to respond.
I know she said that her answer is different from mine, and so now if I say ditto to what Christy, like,
might be different because
this is like circular logic stuff going on, right?
Yeah.
Okay, so I'm going to comment on that from a supporting but different perspective, which is to say that as an originator and as a lender, if you are a traditional service released model, which is the overwhelming majority of it's 100% of brokers, right? Because that's the definition. And then it's the overwhelming majority of IMBs. And believe it or not, it's a lot of banks and depositories and CUs. Christy's organization retains servicing, but they don't retain all servicing. And a lot of banks that could retain servicing don't. Even originators that have traditionally retained servicing have just sold it all in order to raise capital because they were getting 5 and better multiples on their servicing. So you as a loan officer right now today may be working for a company where you feel like you're working for a servicer, but all the servicing just got sold. And so now Mr. Cooper owns all your clients or somebody else. Whether it's, I'm not going to name names, but a huge number of the servicing originators have been in the process of selling all of their servicing to a handful of mega aggregators. And the handful of mega aggregators that Christy referenced when she said double-digit recapture, those are the guys getting 70, 80, 90% recapture. And some of them are very open about it. I spoke with the guys over at Planet Home. They're getting better than 60, 70% on their recapture. And Penny is pretty high, and so is Mr. Cooper. So I think that the point that needs to be made is, as we look at technology, it's very, very, very easy for me as an originator to default to tech and let tech do all the work and do everything through email and tech and tech and tech and tech. But the more you rely on technology, the less your personal fingerprint is on your relationship with the borrower or the potential resources. And so I think it's critical that as an originator, you figure out how to blend tech with human so that you retain some connectivity with your borrowers and with your referral sources. Because if all you are is a computer screen and an email address, there is so little you have the capability to retain a relationship. Relationships happen when people have a cup of coffee together and look one another in the eye. Sometimes it's over Zoom, sometimes it's sitting at a Starbucks. But if you're not shaking hands, then you're missing a huge opportunity, because that really is the value proposition of being a street level player in this business.
A really good point. And moving forward, just given time, let's talk a little bit about technology. I think, Taylor, you shared it's that intersection of how do you combine technology with people to make an excellent service or offering, right? Christy, sort of same question in terms of technology. What observations are you making about the role of technology in the market conditions and the upcoming market? What are you seeing? What opportunities do you see for tech?
Well, I think that this actually applies to a question that we saw pop up from the audience is, the AI revolution is on its way, is what this person said. And they're like, what happens to the average American who...
That wasn't from the audience, Chris. That was the AI bot. That was
the AI bot? Okay. Yeah. Well, AI is getting smarter and smarter. What's that movie where it took over the world? But what happens if an American loses their job and they can't pay their mortgage? Well, I mean, it's like any other job that they lose. They can't pay their mortgage. I don't know that I believe that AI is going to replace people's jobs. Maybe some, but not that many. AI is an enhancement. And I look at that from the way that we're implementing it to the way that other industries are implementing it. AI, at least today, is not able to replace what you or I do. It needs to be used as an enhancement. I love our internal AI that we use that can help me do tasks and make me more efficient and more impactful in my day-to-day role. And that's what I look at when we're implementing things. Yes, it's going to take some tasks off, and I'm going to be able to do more volume with the same level of people. So maybe I'm not out in the market hiring new people, but we're creating capacity and efficiency, but we're never going to be down to 0 humans. And so we have to be careful that what we implement. Historically, we get distracted as salespeople by shiny objects. It's like squirrel, 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 right? They're all over the place. And there's lots of good stuff, but what truly makes business sense and what are you willing to invest in? And I think this is a conversation when you start to think about this, that you need a good brain trust, a good number of people that when you think that you have something that's going to light the world on fire and you have looked at it, that you actually run it by another couple of people in the industry and check that the way that you're thinking about this technology and how it's going to get implemented is realistic and actually doable. I mean, I love that I can pick up the phone and call Taylor. I'll just use you as an example since you're on the call, and you're gonna give me a gut check to make sure that I'm thinking about things in an appropriate way and that I have a different perspective about what I am doing or what I should be doing when I think about technology.
Makes sense.
I
Kat, how about you?
would like to, yeah. I would like to say, I mean, I'm obviously at a venture tech conference right now, and I'm seeing pretty advanced technology, like agentic tech is the new thing, where it could take multiple processes that like vendor management would do or a processor would do to check docs. I want to say that at the end of the day, mortgage is a very compliance heavy industry where if you could be buying back that loan, there's a lot of responsibility. A technology can help make your life easier, but a technology is not going to replace a human still making the decision that this loan is ready, right? To be moved and closed on. So I would say I definitely piggyback what Christy says. I think it's a way to make our jobs less tedious, to focus more on like processing and decision making from the information rather than trying to go in and tediously manage like if you're in an Excel trying to manage the rows and do this and doing that, like it makes our job less tedious and hours on end trying to look and maneuver and pivot and whatever you have to do in Excel, right? And more on, okay, now that this has been analyzed, what is an appropriate decision I as a human need to make, right? Now that I know that I'm getting these credit triggers or these sales triggers in my CRM, I as an LO now need to make a decision. Who do I want to prioritize on calling first, right, today? Or now that it's November, what CPAs are in these tax files of my applicants I should be calling, right? At the end of the day, we as humans can take what engines are analyzing for us and make a decision on how to prioritize to execute and best win in the market that we're in. So
I love it. I think that's exactly how I vision, technology working. Folks have AirPods in, they're technology enhanced, right? So you're enhancing your employee base. So we're about to close up. Last question. Let's definitely leave it on more of the positive note. We're going into 2025. What strategies are going to enable standout performance? What's going to separate folks who just sort of maintain status quo versus accelerate into 2025? Keep it real, a little short and to the point. Taylor, why don't you give us your secret sauce?
I give it away, it won't be a secret anymore. By the way, I don't have any secret sauce. I really don't. Kat said something that was important to recognize relative to technology. In 1831, we changed the world when a guy named Cyrus McCormick invented the Reaper. And the reason the Reaper worked was because farmers could plant their crops in a straight line, and then we could automate the process of harvesting the crop, right? And then instead of using, 40 farm hands to do it, 1 or 2 could do it. And that's where technology is probably taking us, is reducing the number of people necessary to do certain tasks. But I got news for you. I live on a farm. You still have to have 1 or 2 farmers looking around and making sure that the crops work. So I do think that there will be an improvement in efficiencies in many, many different ways. I also think that it can enhance how our business operates and the customer experience, but you still have to have people. It's going to change. How we do things is going to change. There are still lots of people that work in agriculture and in food service and in all the things that feed our country. They just work in different functions today than they did yesterday. Maybe now they're the ones that are building and repairing the equipment instead of the ones that are literally picking the produce out of the ground.
Equipment.
Right? So I do think there's gonna be change. I think that the strategy is, and the secret sauce, if there is a secret sauce, is to realize that the mortgage industry, almost by definition, is a chaotic business because we have constantly changing guidelines with constantly changing implementation and enforcement of regulations, with constantly changing environments. We do not have homogeneous product, right? We have different houses and condos all over the country that don't match each other. So we do not have homogeneous product in any way, shape, or form, other than maybe certain segments of new build construction, which is as close as we're ever going to get to homogeneous product. And we certainly don't have homogeneous borrowers. Like, everybody's got a different story. Every single deal we do on the mortgage side is a custom build based on a unique set of circumstances, based on a unique borrower with a unique property and a unique point in time. Every single transaction is a custom transaction. And so the reason that the Reaper and other equipment like it has been able to modernize and create more efficiency is because they had consistent inputs to then turn into an output, a product. We don't have consistent inputs. We never will have consistent inputs. We are always going to have a chaotic variety of borrowers and transactions. And so for that reason, while AI and technology is going to make things easier, faster, better, and we'll be able to deliver better products, we will never eliminate humans in the process, my humble belief, at least not in the structure of how our mortgage business is created and operates today and has been for, I don't know, 100 years, close to 100 years. So my closing point, and I know I'm over time, is that you got to be personally involved. You got to get out and shake hands. You got to look people in the eye, because the difference between you and, XYZ.com, that you may or may not have paid $14 billion to buy the URL. The difference between you and XYZ.com is the fact that you can look somebody in the eye, shake their hand, and reassure them that you're going to take care of their unique, special, unlike anybody else transaction, and that their family is going to have a nice, safe place to sleep at night.
Christy.
All right, the 30-second thing. The industry is always changing. It has the entire time I've been in the business, since the late 80s, and it's going to continue. You have to build a hypothesis for what you think is going to happen based on whatever information you have available. That shifts and changes over time. So make small bets. Try a number of things that fit with your hypothesis of where the business is going. And when you see what works, double down on that and keep moving forward.
So my last point is really just keep learning. Keep trying to be your best self every day. Keep learning so that you can keep up. And even if things make you uncomfortable in that learning, just try it. Try to do it so that you can be your best self for what the industry is going to take you to in the future. So.
Excellent. Well, thank you so much for joining us. Thank you to our panelists. Thank you to our attendees. Very much appreciate everyone's time, and looking forward to the next one.
Thank you.
Thank you.
Bye, everyone.